Correct me if I'm wrong, private credit basically has floating rate loans, which might be great for people getting 8 or 10% yields right now. But what about all the companies that now have to pay that? Is that sustainable?
Look, there's been demand destruction. So, of course, if you have to borrow at 10% when a year ago you were borrowing at 5%, there's sticker shock. And this is going to play out over a couple of years because we're all in agreement. The Fed's going to be higher for longer. So good companies are hurting, and we're seeing, particularly for smaller businesses, they're running out of options. The banks are not there for them the way they used to be. Wall Street, of course, is focused on big private equity controlled businesses. So yes, of course, we're seeing some demand destruction as a result of higher rates.
Yeah, the Wall Street Journal shined a light on that this week, talking about how rising loan costs are hurting riskier companies. And as mentioned, you're looking at the 30 million companies under $10 million in revenue. I mean, these are micro of the micro caps with debt loads exposed to high rates and maybe a more difficult economy in the next 6 or 12 months.
Well, it's interesting. This is sort of a pyramid, Kelly. If you think about it, you have 30 million companies with less than 10 million of revenue, but then 240,000 companies with revenue of 10 million to $1 billion. So the question becomes, who's capable of banking both segments? That is, checks of 5 million all the way up to 100 million or $200 million for these businesses. There's been a huge sucking sound where private equity controlled companies with bigger EBITDA get a lot of attention from traditional private credit. And obviously banks have been going in that same direction. But now we have, as you point out, the employers of 50, 75 million Americans in this bucket of 30 million companies with less than 10 million of revenue and the 240,000 companies with revenue less than $1 billion. We need a new solution to finance those companies.
Right.
And I'm excited to say I think this is a pro-American conversation. It's a big tent conversation. It's in everyone's interest to figure out how to get capital when you're talking about 50, 60, 70 million Americans employed by these businesses.
And normally the business cycle does that for you. You know, by the end of the cycle, you're extending credit to all sorts of companies you might not have been previously. When it starts to turn, though, and that feels where we are, that credit starts to dry up. So it'll be a more difficult slog for the next couple of years, I would imagine. Can your firm, can the private credit industry, you know, if these were coming from the traditional bank sector, at some point you might talk about refinancing, especially if rates at some point start to drop a little bit. Is there any solution you can offer to take some of the pressure off of these indebted companies?
Well, I think there is, and it's counterintuitive. Do the right thing. If you think about centering businesses that are outside of the coast, you know, today the private credit industry finances basically 5 states. More than half of the capital in private credit goes to just 5 states, Kelly. And so you have 45 states that are not getting the attention they deserve. If you segmented it by zip code, you'd find that 80% of capital actually flows to high-income places. So there is a tremendous opportunity to finance good, growing businesses that need the capital, and this is where values come into play. If you do the right thing, I actually believe the capital markets will give you a lower cost of capital and longer duration capital, either through programs like the SBA's Small Business Investment Company program, or even what you're seeing in the structured products world with step downs for firms that sink capital to communities that need it. If you do the right thing, I think you can actually get the money and help businesses using conservative structures. We don't have to bet on software as a service. We can bet on manufacturing businesses, restaurants. There are so many great industries employing millions and millions of Americans. Right. They need the capital, and they need steady, reliable partners. And this point about demand destruction on the asset side of the balance sheet, I just want to clarify, if you think about it from the liability side of the balance sheet, you've got floating rate debt on that side too. It's harder to raise capital as a private credit shop, just as it is harder to find companies that are willing to borrow at these higher rates. And this is why we got to center creating jobs, focusing on businesses headquartered outside of just the coast.
Yeah, no, I think that people have to get more creative, look at other parts of the market, look at how to win market share, maybe be in some underpenetrated areas to take advantage of those remaining opportunities. Thank you so much for joining us today. We really appreciate it, Damien.